Warren Buffett calls today's stock market traders casino gamblers in his yearly letter. True?
Ever wondered if the stock market is really just a casino in disguise? It's an intriguing notion, isn't it? A place where fortunes can either be made or lost in an instant. It's no secret that the stock market is often viewed as a gambling arena, a place of high stakes and unpredictability. But is there more to it than just luck and chance? Or are we all just playing a game of financial Russian roulette? Let's dive into the world of stocks and spins. Everyone knows that a roulette wheel is a game of chance, but how about the stock market? Consider the roulette wheel. It spins, the ball dances around, and where it lands, pure chance. Is the stock market any different? It's not as straightforward as you might think. Imagine the roulette wheel as the stock market. Each slot represents a different company's stock. You place your chips, or in this case, your hard-earned money, on the slot you think the ball will land in. If you're right, you win. If you're wrong, you lose. The unpredictability of the roulette wheel mirrors the volatile nature of the stock market. In both scenarios, there's a certain level of risk and uncertainty. You can study the wheel, watch it spin and predict where the ball will land, but it's never a sure thing. Similarly, you can research a company, understand its financials, and predict its stock performance, but there's always an element of risk. Market conditions change, unexpected events occur that can dramatically affect a company's stock price. Now you might be thinking, but that's gambling, not investing. Well, you're not completely wrong. Investing in the stock market does involve risk, much like gambling. But here's where the two diverge. In gambling, the house always has the edge. In the stock market, you can tilt the odds in your favor. How? By doing your homework. Researching a company, understanding its financials, and keeping an eye on the market will give you an edge. It's not a guaranteed win, but it's a strategy that can increase your chances of success. So, while the stock market might seem like a roulette wheel with its unpredictable spins and uncertain outcomes, it's not entirely a game of chance. Yes, there's risk involved, but there's also the opportunity for reward. And remember, unlike the casino, you can influence your odds in the stock market. So, just like the roulette wheel, the stock market spins can be unpredictable. But is that the whole story? In a casino, the house always wins. Is there a house in the stock market too? Just as the croupier spins the roulette wheel in a casino, the world of stocks and shares has its own players who often seem to have the upper hand. These are the large corporations, the institutional investors, the hedge funds. They're akin to the house in a casino, operating with a level of information, resources and influence that can seem daunting to the individual investor. Imagine the stock market as a bustling casino floor. The high rollers, these institutional investors, are at the VIP tables playing with stacks of chips that dwarf those of the casual gambler. They have access to high-level data, advanced trading algorithms, and teams of analysts working around the clock. They can influence the market, create trends, and even set the rules of the game. It's easy to feel like an underdog in this environment. But here's the twist. While the house may have the advantage, it doesn't mean they always win. And it certainly doesn't mean that you can't. The stock market is not a zero-sum game. With informed decisions, strategic investments, and a bit of patience, it's possible to carve out a profitable path. Think of it this way. You're not trying to outplay the house. You're navigating the game that the house has set up. You're studying the trends, understanding the odds, and making calculated bets based on your own risk tolerance and investment goals. And sometimes, those bets pay off. There's a thrill to it, no doubt. But unlike in a casino where luck is the major factor, the stock market rewards knowledge, strategy, and long-term thinking. It's about more than just rolling the dice and hoping for the best. It's about playing smart, staying informed, and making decisions that align with your financial objectives. Just like in a casino, the big players often have an edge, but remember, even the underdog can win with the right strategy. Ever heard of the gambler's fallacy? It's more relevant to the stock market than you might think. The gambler's fallacy, also known as the Monte Carlo fallacy, is a misconception rooted in the human mind's persistent pattern-seeking tendencies. It's the belief that if an event occurred more frequently than normal during a certain period, it would happen less frequently in the future, or vice versa. Let's say you're tossing a fair coin, and it lands on heads 5 times in a row. The gambler's fallacy would lead you to believe that the next toss is more likely to land tails to balance things out. But in reality, each coin toss is independent of the others, and the odds remain 50-50. How does this apply to investing? Well, Think of a stock that's been on a winning streak, with prices climbing higher and higher day after day. The gambler's fallacy might lead an investor to believe that this stock is due for a fall, leading them to sell off their shares. But just like the coin toss, the performance of a stock is not dependent on its past. Stock predictions can be likened to predicting the next number on a roulette wheel. There's a fundamental randomness that can't be accurately predicted, and past performance doesn't guarantee future results. Yes, financial analysts use historical data to make educated guesses, but they're just that, guesses, not certainties. It's crucial to remember that each day in the stock market is like a new roll of the dice. Past trends can provide insights, but they're not a crystal ball. Investments should be based on careful research and sound financial principles, not on the illusory patterns perceived in past performance. So, here's the takeaway. Don't let the gambler's fallacy trick you into making poor investment decisions. Don't assume that a stock on a winning streak is bound to fall, or that a losing stock is due for a rise. So just like in a casino, the past performance of a stock does not guarantee its future results. So if the stock market is like a casino, how do we avoid falling into the trap? This question brings us to the crux of the matter. Let's look at some practical tips that can help you navigate this financial game of chance with a strategic edge. Firstly, it's essential to remember that investing is not about luck, but it's about research. Just as you wouldn't bet on a horse without knowing its track record, you should not invest in a company without understanding its financial health, its competitive position, and its future prospects. So, take the time to study before you stake. Secondly, never put all your eggs in one basket. Diversification is a fundamental principle of investing. By spreading your investments across different sectors, regions, and asset classes, you can buffer against the volatility of the market. Think about it, if you were in a casino, would you bet all your chips on a single number at the roulette table? Probably not. Investing should be approached with the same caution. Thirdly, don't be swayed by short-term fluctuations. The stock market can be a roller coaster ride, and it's easy to get caught up in the thrill of the ups and downs. But remember, investing is a long game. It's not about making a quick buck, but about building wealth over time. So keep your eyes on the horizon, not on the daily ticker. Finally, don't let emotions drive your decisions. Fear and greed can be powerful motivators, but they are poor guides. It's easy to panic when prices drop or to get greedy when they rise, but these knee-jerk reactions can lead to poor decisions. Stay calm, stay rational, and stick to your strategy. So there you have it. The stock market might seem like a casino with its flashing lights, ringing bells, and high stakes. But unlike a casino where the house always wins, in the stock market, you can tip the scales in your favor. It just takes research, diversification, patience, and emotional control. Remember, the stock market might have its casino-like elements, but with careful strategy, you can still come out on top. So, is the stock market really like a casino? Well, let's revisit what we have discussed so far. The stock market, much like a spinning roulette wheel, is a whirl of unpredictable forces. Prices fluctuate, stocks rise and fall in a show of dazzling unpredictability. But unlike roulette, the stock market isn't a game of pure luck. Knowledge, analysis, and strategy can tilt the odds in your favor. In Playing the House, we saw that the market, like the casino, often holds the advantage. But unlike the casino, the market's edge isn't fixed. With savvy investment choices and calculated risks, you can turn the tables. We also talked about the gambler's fallacy, the dangerous belief that past performance predicts future outcomes. In both the casino and the stock market, it's essential to leave this fallacy at the door. Each spin, each trade is a new event, independent of the last. And remember, the best way to avoid the casino trap is to invest for the long haul. Short-term trading might seem tempting, but it's akin to playing slot machines. The real winners are those who play the long game, who invest wisely and patiently over time. Just like a casino, the stock market has its risks, but with knowledge and strategy, you can play to win.